I'm good. Oh, hi guys. I see some young people wearing masks. Ah, come on, Yakov. Um, Yakov asked me to talk about Bitcoin, and at first I thought I wanted to show you a short video and then go into a question and answer session, but I decided not to do to forget the video. We can just go into this kind of an improvised session. I have some notes I'd like to talk about, but that shouldn't take too much time, and then we can maybe go into an open discussion. Now, I want you guys to interrupt me at any point because I have basically a couple of themes that I want to discuss. So let's talk about the first theme: is who thinks that Bitcoin is a currency? That that's sort of the media always keeps saying that Bitcoin is a bad currency because it costs too much to transfer and there's only 7 transactions per second, etc., etc. This whole idea that Bitcoin is a currency, I think, is mistaken, right? Because if you look at the kind of a more fundamental phenomenon of money, right? Money can be thought of as something that has three key attributes, which is or three key. It's basically you can think of money as any good in the marketplace. Imagine kind of like an open bazaar somewhere in the ancient world, right, where all goods are for sale. You have anything from slaves to gold to fish. Whatever is for sale, right? Well, money ends up being any good that gets that has the highest saleability in the marketplace. In other words, it's any kind of good that's easiest to get rid of in exchange for other goods, right? But the function of money is to move value across space and across time. And the part where moving value across time, that's the part that the modern fiat narrative doesn't want you to think about, right? Because the conventional wisdom is that money is something that you use to pay for things. But that's only one dimension of its use. In other words, it's only moving value across space. Now, from me to you or from me to somebody else somewhere else in the world. But moving value across time, in other words, being able to leave some inheritance to your children without that value being diluted or destroyed or endangered in any way, that's called, think of it as moving value across time, right? If we live in space-time, as Einstein taught us, right, that we live in a four-dimensional space-time, we need to move value not just across space, but across time as well. And historically, the only thing that's worked very well to move value across time are things that are hard to make more of. And specifically over thousands of years, the one thing that's been really hard to make more of is gold, right? Now, silver also used to be a precious metal that was kind of had monetary premium in it, so to speak. But basically, hardness of money refers to something that just simply reflects how hard it is to make more of it, right? You can think of history of civilization as this constant search for some kind of substance or commodity that's hard to debase, that's hard to produce more of, right? So you can think of, like, for example, in the early African societies, one popular form of money was cattle, right? It takes a while to grow a cow, right? If you use cows as your money, then making more cows requires 5 years of grazing to grow a new cow, a new adult cow. So cattle actually was a pretty good form of money because with it you could leave money to your children. You could and you can put up dowries for your daughters. You could basically pass it on to future generations as long as your little herd of cows is taken care of. But it was really bad at moving value across space, right? What if you need to send your money 100 miles away? Well, you need to march with a herd of cows. It's not an easy operation to conduct, right? Because cows need to be taken care of, etc. Also, it's not necessarily the case that neighboring tribes would accept cows for payment, right? So you had, in the history of money, you had basically any conceivable commodity being used for monetary purposes. So there's an old American expression, shelling out. Now, it comes from early settlers who arrived here, the pilgrims, right? They basically had some silver and gold coins with them from the old country, but they quickly realized that the local tribes are not interested in that kind of stuff. And local tribes of Indians, right, were using wampum shells, and hence the old American expression shelling out, meaning paying for something, is because pilgrims were using wampum shells. They started using them along with native tribes, right? Those wampum shells were difficult to find. They basically could be stored for long periods of time. It was just a physical commodity that was difficult to debase. In other words, even if you send your whole tribe in search of new wampum shells and they spent months walking along the beach, in the end, they would probably increase your supply of wampum shells 5 to 10% relative to the entire supply that was already hoarded over generations, right? So let's introduce this new metric for scarcity, right? I want to introduce the new metric for scarcity, and let's call it stock to flow. Now, stock to flow refers to take the entire stock of some commodity, be it cattle or shells or gold, and compare it with the new annual supply. So just divide the stock of some commodity by the new annual supply. And what you get is what's called the stock to flow ratio. Now, stock to flow ratio of gold, for example, right now is 60. Now, what does it mean? It means that there is roughly 120,000 tons of gold that's been hoarded over the last few thousand years, in bank vaults or in jewelry. In India, there's like 30,000 tons of gold floating around in women's jewelry in India. Basically, poor women in India walk around with their savings on their necks and just carrying gold chains, etc. So basically, the entire stock of gold has been growing. In fact, it's probably it grew about 3 times since the year 1900, right? As we enter 20th century, there was like 30 to 40,000 tons of gold above ground that's been piled up in the previous 5,000 years. Now, in the last 120 years, we've tripled that stock from 40,000 tons to 120,000 tons. But we can only mine about 2,000 tons per year. So gold has this very high stock to flow ratio. And why is the stock to flow ratio important? Here's why it's important. If the price of gold doubles or triples, gold miners will go all out to mine more gold. But because the stock to flow ratio is high, even if gold production is doubled or tripled, relative to the total amount of gold that's already available for sale, it will not make much of a dent in the market. And this is what makes gold hard money. The fact that it's hard to make more of it relative to the existing stockpile, right? Now, let's look at Bitcoin. What is the stock to flow ratio of Bitcoin? Well, about 10 months ago, there was this happening event where supply of Bitcoin was cut in half. You might have heard about, this happens every 4 years. And right now, after that point, the production of new Bitcoin fell below 2% annual inflation rate, which gives us the inverse stock to flow ratio of around 50. So now we have gold with a stock to flow ratio of 60, and we have Bitcoin, which is almost as hard as gold, right, given the current issuance rate of Bitcoin. Now, in another 3 years, Bitcoin will experience another halving of supply, and then Bitcoin stock to flow ratio will hit 100, and it will exceed hardness of gold. And from that point forward, Bitcoin scarcity just escalates exponentially every 4 years by a factor of 2 until it reaches infinity, while gold has sort of maintained its stock to flow ratio of 60 over the years. Now, so what we see here is that Bitcoin is actually the hardest form of precious commodity or money or whatever you want to call it that's been ever invented. Why? Not only does it have a very high stock to flow ratio, right? So for example, gold is still slightly ahead, and that's why you see the market cap of gold is still $10 trillion, while Bitcoin a few days ago crossed $1 trillion. Because with the increase of stock to flow ratio, the total amount of value that will be stored in the commodity escalates exponentially. But Bitcoin is another thing that has a very special property that's never been seen before, which is it's the first substance or commodity or digital commodity or whatever you want to call it that is completely irresponsive to demand. Whose supply is completely not responsive to demand. What does it mean? It means even if the price of Bitcoin goes up 1,000 times, and Bitcoin miners go all out and build 100 nuclear power stations to mine it, they will be unable to increase its supply. That's not the case with gold or silver or any other thing known to man. Now, there is one exception. You can think of it. What about paintings by Picasso, right? Now, Picasso is dead, so you can think of paintings by Picasso as a very scarce commodity that has no new supply, right? So in that sense, paintings by Picasso is a kind of like a precious store of value commodity that has an infinite stock to flow ratio. So it seems like it would make for good money. The only problem with it is that it lacks all other useful attributes of a monetary commodity, right? It's not fungible. One painting is not equal in price to another. There's very few paintings, maybe a few hundred, right? They also, over time, they also tend to, fall apart and disintegrate, et cetera, et cetera. It's not divisible. It's not easily transferable. It's not easily assayable for authenticity, right? You need experts. So there are things that have infinite stock-to-flow ratios, like paintings by Picasso, or maybe Beverly Hills mansions, or Hamptons mansions, right? Once all the mansions have been built out in Hamptons or Beverly Hills, to the extent that people use these commodities as monetary stores of value, they have a monetary premium. In other words, they have premium that is not justified by an income stream that these assets can produce. So, for example, a mansion in Beverly Hills will usually sell not for 10 to 15 times its annual rent, which is what a house in Ohio goes for, but it will sell for 50 to 100 times the amount of annual rent that you need to pay in order to live in that mansion. So now you can see that like maybe 80% of the $50 million price of a Beverly Hills mansion is actually not the cost of real estate. It's the monetary premium put on it by millionaires and billionaires who collect these assets in order to, number one, store value, and number two, which is even more important, is these assets are used to mine more fiat currency. Now, how does fiat currency mining work in the fiat system? It works by putting up something as collateral and creating more debt against it. Now, anytime you buy a house and the bank issues $500,000 mortgage, that's a mining event in the fiat system, right? Because the bank turned around to the Fed created $500,000 out of nothing, gave it to this bank for a fraction of a percent. The bank turned around and gave you the $500,000 while taking your house on its balance sheet as collateral and keeping your loan on its balance sheet as an income-producing asset. So this is the sort of the secret of Wizard of Oz, right? In this Oz land that we live in, the fiat standard that we're on right now, right? Some people call it the fiat dark ages that we're about to exit because Bitcoin is about, is at this point, Bitcoin is essentially won, right? Once it crosses $1 trillion in market cap, you can no longer argue with it. And you could argue with Bitcoin at $1 million market cap or $1 billion market cap or maybe even $100 billion market cap. But a few days ago, it crossed $1 trillion in market cap. And at some point, you should just shut up and watch, let the nature take its course, because like Bitcoin and the rest of the world don't care about what New York Times editors are writing about Bitcoin. I mean, if that hasn't sunk in yet, nothing will help, right? Like and also Bitcoin doesn't care what Grandma Yellen is yelling at the clouds today, right? Because it will continue spreading around the world because it suits people around the world. It's not a Western-centric phenomenon, right? People in Turkey are storing their savings in Bitcoin because their government has been debasing their currency for decades. Argentina, Venezuela, even China, right? Bitcoin is a means of escape from the Communist Party capital controls. So it will continue growing. It's unstoppable. And, well, I digress. So I was talking about monetary premiums, right? So you have basically monetary premiums in real estate. You have it in art. You have real estate is basically used as a way to access mining capabilities in the fiat system, right? Let's look at some billionaire. Let's say Elon Musk, right? So he has $1 billion in Tesla shares, but he wants to buy a super yacht or a mansion in Beverly Hills. So what does he do? He talks to Goldman Sachs or he talks to JP Morgan, and they have a special department called private banks in there. And they take 1 billion shares of Tesla stock off his hands onto their balance sheet as collateral. Unknown caller. And then they issue him 50% of that collateral, let's say $500 million of that collateral, as a 1% per year line of credit that he can tap in any currency 24/7 worldwide to do whatever the hell he wants. So what just happened? Elon Musk has an unrealized capital gain of $1 billion. He simply does not sell his asset that continues escalating in value, which is Tesla stock, but instead he puts it up as collateral with Goldman Sachs or JP Morgan, right? Then he takes $500 million from his credit line, which is also not a taxable event, right? So there's no taxes being paid here. He gets to mine $500 million of new fiat into the money supply. And then he can buy, let's say, 5 Beverly Hills mansions, a huge penthouse in Manhattan, and a Hamptons mansion, and a $100 million super yacht, right? As he buys these assets, he can repeat this procedure. He can just take their title to all these assets and send it back to Goldman Sachs to add to his collateral. So now he has $1.5 billion of collateral at Goldman Sachs, and his credit line is now increased 50% to $750 million. Notice that he's owning all these assets. Now, it's true that they've become somewhat encumbered because Goldman Sachs is now holding them as collateral, but he gets to enjoy them any way he wants. He's paid no taxes. He got to mine very favorable new fiat into the system by undergoing this collateralized mining operation. And why does the system privilege this? It privileges it because Goldman Sachs is essentially a local franchise of the Fed and has access to infinite printing of money. So Goldman Sachs can never go out of business. It's a systemically important institution. It can always turn around and take $100 billion from the Fed at next to zero interest rate, as long as Goldman Sachs puts up, you guessed it, treasury bonds as collateral with the Fed. And on and on and on, this kind of Ponzi-like, let's collateralize the world procedure continues. So what's happening is that basically in this system, there is a privileged class of people that are sitting next to the printer. They don't get, suitcases of $100 bills handed to them by the Fed. What they get instead is they get to mine fiat into the money supply and then acquire additional assets with that fiat, which they can add to their existing collateral, and therefore they get to mine more fiat. Now, as his Tesla price escalates, because number one, Tesla is a productive asset that's outpacing inflation, and number two, as Fed is debasing the currency, the stock market has now become a refuge to save your wealth, because it otherwise, by simply sitting in a savings account, is getting debased 15 to 20% a year. So if you invested in the S&P 500 index or Beverly Hills mansions, you have a chance to outperform 15% a year debasement or not. But for regular 90% of population, certain things have become unthinkable. Like, for example, retirement is no longer a thinkable proposition for like 80% of the population. Why? Because until like 20 years ago, in order to buy $50,000 worth of income in retirement, you needed $1 million saved up in your nest egg. And then at 5% in some municipal bonds or state municipal bonds that are tax privileged, you could live for $50,000 a year for the rest of your life and then leave this $1 million in principal to your heirs as inheritance, right? Well, how much does it cost to buy $50,000 annually for retirement now? It costs $10 million. So the cost of retirement went up 10 times. You will not see this cost reflected in the CPI statistics, right? CPI statistics just represent a basket of consumer goods that are manufactured industrially, right? Including industrially manufactured, sludge food in factory farms with hormones, etc. And that basket will continue to be deflating, because it's a highly industrialized process where the cows are herded by the millions through stalls, and they're injected with all kinds of antibiotics and hormones, and that food continues falling in price, if you can call it food. It's basically just some industrial sludge that's being reprocessed into hamburgers at McDonald's, right? To feed the masses, so to speak. But if you want things that are scarce, those things are going to be growing in prices 15 to 20% or more per year. Just check how much your average Beverly Hills real estate, mansion has gone up in the last 10 years. Or what about the price of college education, right? That's been outpacing inflation very nicely, thank you very much. So in other words, only things that are scarce are experiencing inflation. Things that are not scarce, like digital goods, you can stream all your music from Apple Music for $15 a month. That's like unthinkable in the 60s. People used to spend 20, 30% of their annual salaries buying records just to enjoy music. Now for $15 a month, you have a library of 100 million songs from around the world that you can listen at super high fidelity, right? That's because the marginal cost of producing those goods is basically zero. So digital goods will continue deflating. Manufactured goods will continue growing at 0 or 2 or 3% inflation, and then scarce goods will continue outpacing debasement by the Fed, which is 15%, 20 to 26% in the last 12 months. So the size of M2 money supply has grown 26% in the last 12 months. And according to the statements by the Fed officials, it's going to continue growing at 15 to 20% in the next 5 to 10 years. That's the real inflation number. It's the size of M2 money supply across the economy. It's not the price of a basket of consumer goods that are basically enough to keep somebody alive and unhealthy if they live in their mother's basement playing video games. But if they want to have a house where they can start a family, that's not included in the basket of consumer goods, right? Neither is retirement, neither is healthcare, or final years of life care, or education, or whatever. So let's go back to the original principles. Bitcoin is a form of monetary commodity that has a monetary premium, like other monetary commodities, like gold, like silver used to have, like Picasso paintings, like Beverly Hills mansions. However, in addition to having a very high stock-to-flow ratio, which is a metric of scarcity, at this point, the only thing scarcer than Bitcoin is gold, but that's only for another 24 months or so. It also possesses unbelievable monetary properties that no other monetary commodity has ever possessed. For example, gold cannot be transferred easily across space, right? If you saw recently in the news, Germany tried to take possession of a few hundred or 1,000 tons of gold from New York Fed. The operation took about 5 to 7 years and cost them $200 million. Because the gold had to be loaded onto ships, guarded by Navy vessels, and then drilled. Every bar had to be drilled to assay it for authenticity, for whether it's real gold or not. So gold basically is terrible at moving across space. Fiat is terrible at moving across time. Bitcoin is going to be infinite scarcity commodity that will be essentially eternally moving across time without any debasement. In a few years from now, there will be like the last Bitcoin. You can assume that all 21 million have been mined out already because we're closing in on 19 million, and it'll take 140 years to find the other two. So across time, Bitcoin cannot be debased, right? It's not possible to increase its supply. Across space, it moves just fine, but it moves in these large transactions. Think super tankers. Don't think, like paper airplanes, right? So Bitcoin base layer is highly designed and optimized for final settlement, meaning each Bitcoin transaction can represent a once-a-day transfer between two central banks around the world of $10 billion. And these transfers can batch up individual credit card payments that have happened between all the consumers in these two countries that were addressed to each other. So basically, a single Bitcoin transaction can actually provide final settlement for 1 million smaller payments that are conducted using Visa, for example, right? Because there's no reason, for example, that Visa cannot add Bitcoin as yet another currency number 55 or whatever to its network. In fact, recently there was a public announcement to that effect that they intend to do this by the end of the year. So Bitcoin transactions are basically Bitcoin is optimized for survivability and for self-sovereignty, meaning that you do not need to trust anyone to conduct a full audit of Bitcoin's source code and the entire transaction history to ensure for yourself, without trusting any third party, that Number one, every transaction has been legitimate and signed by the previous owner of the coins. And two, there's been absolutely no inflation other than the inflation that was specified in the initial design of the system, which has this curve-like, ceiling at 21 million. So no trust is absolutely required. Okay, so let's if you guys have any questions, I'll go into other little topics. So a popular question is always, is Bitcoin a Ponzi scheme? The media says, well, it's a bubble, it's a Ponzi scheme, it might crash at any time. So let's think about this. It's often compared to tulips. I don't know if you know much about the tulip mania that was in Holland in 1600s, where people were growing ever more exotic and beautiful varieties of tulips, and the prices would escalate. The tulips were kind of a meme coin, right? They were a coin where people were just basically obsessing over these tradable, non-fungible tokens, they're called these days, but they provided no utility as a monetary commodity, right? They provided no utility, whereas Bitcoin provides hardness, it provides scarcity, it provides auditability of the entire history, it provides incredible divisibility, it provides all these monetary properties. It's impossible to counterfeit, it's impossible to seize from you if properly secured, right? It's impossible to stop transactions. You do not need any central third party to transact with anybody else in the world. There's no gatekeepers in the Bitcoin system, et cetera, et cetera, et cetera. It's basically alien technology from the future that fell into our present somehow, whoever the Satoshi Nakamoto character was, right? So what's happening right now is that the market is freely choosing Bitcoin as a store of value gold 2.0 commodity, right? The market doesn't want to use Bitcoin as means of payment. You would have to be crazy to spend Bitcoin on pizza, like that famous pizza that was sold for 10,000 Bitcoin. Because at this point, you're seeing something that humans haven't seen for the last 2,000 or 3,000 years, which is monetization of a new commodity. In other words, attaining of a monetary premium by commodity that previously only had utility value, right? For example, look at potatoes. Potatoes have utility value, right? They're food. You can eat them. They can be sold in the marketplace. It's a pretty saleable good. But they have no monetary premium because nobody in their right mind will store value in potatoes, right? Because these potatoes will rot, or the harvest will triple, and then therefore you'll lose, the prices will collapse, and so on and so forth. So in order to have monetary value, something must be not just scarce, but have all these other monetary properties. And Bitcoin basically has them. So let's go back to the question of whether or not it's a Ponzi scheme. So what if Bitcoin is this video game that people play on the internet, right? And early adopters have grabbed all these scarce tokens, and they're just waiting for all the noobs, all the billions of new adopters to come in so they can offload these things onto them, right? Because early adopters grabbed a lot of Bitcoin for cheap, and now new people are desperately trying to acquire it because everybody's trying to get to buy something that's going to be worth $10 million in 5 years, right? Well, there's definitely waves of human sentiment in the Bitcoin market. There's bulls and busts, bull runs and bear markets, but at the end of the day, one Bitcoin will be worth one Bitcoin, right? If you stop thinking about Bitcoin in dollars, you see that you're just acquiring a percentage of a total supply of a highly scarce monetary commodity. The moment you realize that one Bitcoin will always be one Bitcoin, and the moment that 1,000 other people in the world realize the same way, you're competing for finite slices of finite pie that, as it attains liquidity around the world, and it becomes more and more useful as a store of value. So one parting thought on the subject that I'll say is that as the price of Bitcoin goes up, the risk of ownership of Bitcoin goes down. Now, that's not the case with oil. That's not the case with gold. That's not the case with Tesla stock. Everything whose price goes up, the risk of owning it usually goes up with the price because, as the price gets higher, production increases and then the price will fall. Or with Bitcoin, increasing price is a lagging indicator. It's not a leading indicator. It's a lagging indicator for how much of acceptance as a new monetary commodity it has attained in the world. And the higher the price is, the higher the liquidity of all the coins that are tradable at any given moment, right? So if at any given moment 3 million coins are mobile and moving, and the price just doubled, well, you just doubled the liquidity of a monetary network. So what does it do to a monetary network whose liquidity doubles? It doubles or quadruples its utility, right? A monetary network is only as good as its ability to route money, right? To store money and to move money from point A to point B. So the growing price of Bitcoin entrenches Bitcoin and makes it less risky. I want to see something else where that's the case. That's not the case with anything else. Now, maybe you could say things like Tesla, right? A growing price of Tesla allows Tesla to borrow billions of dollars at low interest rates and build more factories, so it can complete the destruction of the internal combustion engine industry, right? So in that sense, the bigger the Tesla is, the harder it is to stop as well, and maybe it becomes a less risky proposition to own Tesla stock as well. So in that sense, it's maybe similar. But back to the question of the Ponzi scheme. Well, what about classic Ponzi scheme is just something where you have a central operator operating a pool of capital where the first subscribers are paid by subsequent newcomers, and the first subscribers to this pool get extraordinary rewards, whereas at some point, once the scheme runs out of suckers, it goes bust and the whole thing goes away. Well, Bitcoin clearly doesn't fit that definition of it, right? Because there's no central anything in it, number one. Number two, no return is promised, right? There's no like 20% promise like Bernie Madoff did. So clearly Bitcoin is not that kind of, but what if it's more of a Ponzi scheme, kind of like a mass mania, like the tulip mania? Well, if you widen your definition of a Ponzi scheme to mean things like that, then you have to start talking about things like Social Security, right? Isn't the Social Security system a kind of a Ponzi scheme too, right? So you have people contributing now, while people who are retiring now are getting those contributions. And then they make a promise to you that when you retire, future contributions will pay for your retirement. Now, maybe that's the case, maybe that's not the case. But in a sense, it's kind of first in, first out type system where first subscribers are benefiting at the expense of later subscribers, right? Later participants. So if you widen the definition of a Ponzi scheme to be completely like a phenomenon where people who are in first benefit more than people who come in later, then a fiat banking system or United States dollar is a Ponzi scheme too, as is Social Security system. Therefore, the whole definition of a Ponzi scheme becomes kind of useless. It just becomes too broad, right? It doesn't really mean much. What else? Let's talk about what Bitcoin actually is. So what Bitcoin is, it's a network effect. It's not a Ponzi scheme, right? There's a difference between a network effect and a Ponzi scheme. A network effect is exactly this monetary network attaining liquidity and attracting more participants. And this attracting of more participants, and the bigger it becomes, the more utility it has, that gains a life of its own, right? 5 years ago, holding Bitcoin was a very lonely proposition because you could only basically hold Bitcoin and hope for a brighter future. Today, your Bitcoin is accepted as collateral for loans, where you can basically borrow money for your mortgage without selling your Bitcoin. So what just happened? You just had 25 finance companies join the Bitcoin network in providing services to the holders of Bitcoin on that network, and therefore they made the network more useful, and therefore this network will attract more participants. So it does have a network effect, but that's not to be confused with the Ponzi scheme effect, right? It has kind of a self-propelling nature. The bigger it is, the bigger it's going to become. So in that sense, think of Bitcoin as a huge network effect. In fact, it's 7 network effects operating in parallel. There's a network effect of mining. There's a network effect of Bitcoin exchanges around the world creating liquidity. There's a network effect of merchants accepting it for payment. There's a network effect of on and on and on. There's like multiple network effects operating. And money being kind of a base layer of civilization is sort of like the ultimate technology that everything else is built upon. Therefore, its network effect is the most powerful, and therefore there's no way at this point that any other coin, no matter how more technologically advanced, can compete with Bitcoin's network effect, because Bitcoin's technological attributes are beside the point. What matters now is that Bitcoin has $1 trillion of liquid capital that's essentially ready to fly around the world 24/7, 365. In fact, there's been a statistic that says that even though Bitcoin has existed only for 11 years, or 12 years, I should say, because it's been trading 24/7, 365, it actually has had more trading hours than 90% of S&P 500 companies have had. Because stocks on Wall Street only trade 9 to 4:30 and not on weekends and holidays, whereas Bitcoin never sleeps, truly, right? So it's trading 24/7, 365 against every currency pair in the world, and you have this $1 trillion worth of unseizable capital that's completely borderless, that just keeps multiplying and sucking into its orbit more and more services like banks, providers, all kinds of stuff, all kinds of participants are joining the network. And I distinguish that kind of monetary network from the Bitcoin, the technological network, which is moving blocks around and transactions around. That's kind of like the lowest level of this cake, right? But this cake has many, many, many layers, including providers, governments. There's 4 countries in the world today that are stockpiling Bitcoin in central banks, right? You have North Korea, Venezuela, Iran, and there's rumors that Singapore or maybe even Switzerland have started stockpiling Bitcoin, but they will not announce it because that might anger other people, right? So basically, you now have pariah countries like Iran, North Korea, Venezuela that have been forced to stockpile Bitcoin because Iran needs to sell its oil for something, right? And they can't use international payment rails because they've been blockaded. So they will sell their oil for Bitcoin now, and they're also doing Bitcoin mining. And that kind of and those transaction flows cannot be stopped by the United States, right? So it's not a Ponzi scheme; it's a network effect. Moving on. Yes, it's okay, Jakob. It's all right. Don't worry about it. Yeah, I would prefer to be interrupted with questions rather than to defer all the questions to the end. So if we're discussing some topic and you have some questions or comments on it, yeah, go ahead. Well, we will go into deflation. Now, you might think that you're not familiar with deflation, but in fact, all the computer chips and cell phones and computers that you've been using as you've been growing up, they've been deflating at an incredible rate, right? I remember buying a computer with 4 megabyte of RAM and paying 3,000 for it in late 80s, right? So now for $3,000, I can buy a computer that's a million times more capable. That's called deflation, right? The same amount of money buys you more goods. So you can think of the same way because Bitcoin is infinitely divisible. Now, at this point, the standard protocol allows division of a single coin into 100 million sats or satoshis, right? Now, a US dollar is like something like 1700 satoshis. There's, like a Japanese yen is 16 satoshis at this point or whatever it is. But in the Lightning Network, each satoshi can be divided into another million pieces. Now you can see how 10, 20 years from now, you can keep subdividing satoshis into 9 more decimal places or whatever without affecting anybody's ownership stake. It's similar to how a stock is split on Wall Street, right? So because there's infinite divisibility of each coin, there's never going to be any problem with not enough units being around to conduct commerce. But deflation will definitely be the new normal, right? Because Bitcoin will simply be similar to what S&P 500 is today. Owning one Bitcoin in the future will be like owning an index fund on the economy. By simply stashing your savings into Bitcoin, you will be guaranteed to do as well as an index fund of all the companies operating in an economy. Which is, by the way, the only way to evade inflation today is to have your own private hedge fund, which is hunting to outrun that 15 to 20% debasement that the Fed is doing, right? So if you know many people with their own private hedge fund, maybe those people can outrun inflation. As for the rest of us, the only shelter is things like Bitcoin and maybe other highly scarce assets like, maybe if you buy that Malibu mansion or Hamptons mansion, it will do okay with inflation to come, right? But other than that, there's very few places to hide. Yeah. I'm talking, when I say inflation, what I mean is a basket of goods and services that I will personally want to consume throughout my lifetime, right? As opposed to one size fits all synthetic basket for everybody, which is what CPI is. And then CPI conveniently excludes assets like stocks, bonds, real estate, retirement, right? All those things are excluded. If you want to have a house in the future, if you want to have retirement in the future, if you want your kids to have a highly scarce degree from Harvard, you have to put those things into your own personal basket that you will measure your inflation by. Now, if you compose this basket for yourself, you will quickly see that over the last 10 years or 20 years, that basket has been going at 20% a year. Not 3, not 2, 20. That's the real debasement of your value. So by simply putting your money into a money market fund at 1%, you're losing 15 to 20% of your personal value for your personal future inflation basket expenditures. If you're going to live in your parents' basement, play video games, and eat industrial sludge, then CPI is your inflation basket because it's designed for people living in their parents' basement, playing video games, having minimum wage jobs, and eating industrial sludge food. That is what CPI is. But if you have higher aspirations than that, for example, if you want healthcare, if you want education for your kids, if you want a house, if you want a second house in Hamptons, you could be a big Wall Street shark making $1 million, but boy, $1 million doesn't buy a house in Hamptons anymore, not even paying for mortgage, right? It used to be that every Wall Street shark would have a Hamptons house, but nowadays you have to be a hedge fund, dude, in order to own a Hamptons. A regular broker, no matter how, or a trader, cannot afford a Hamptons house. Apparently, Hamptons house is a consumer good that people want. So for them, it's part of their inflation basket. I will not put any moral value on whether or not those houses are good and what kind of parties happen there, what kind of drugs are consumed there, whatever. The point is that everybody has their own basket, and CPI is a basket for people dwelling in their parents' basement, in other words, having no aspirations to own property and having no aspirations to go to college and just eat industrial food. That's what CPI is. Okay, if you truly want the answer to that, is you have to stop measuring that asset in dollars. That's how you place value upon it. The moment you stop measuring Bitcoin in dollars is the moment you'll have your little aha moment over your head. It's only volatile in dollars. In Bitcoin, one Bitcoin will continue to be one Bitcoin. In other words, one Bitcoin will retain the total percentage ownership of the entire supply, which your $1 million will not, right? You think that $1 million is a stable ownership stake of something. It's not. It's ever decreasing percentage of the total ownership stake of the entire fiat pie that's being inflated. Whereas possessing one Bitcoin guarantees you 1 in 21 million shares of the entire pie for life. So from that perspective, there's nothing less volatile than Bitcoin. If, however, you're just buying Bitcoin as a speculative investment and your unit of account is US dollars, its price is volatile and it will remain volatile for a while because you're having a phenomenon where something went from total capitalization of zero to it will eventually level off at total market capitalization of about $200 trillion because that's all the monetary premium across all asset classes in the world. And that monetary premium will all escape into this black hole called Bitcoin. At that point, Bitcoin will become the most stable thing we've ever seen. It will become more stable than gold was during the gold standard. But until that time, it undergoes a series of fear greed based bubbles where it never collapses to zero, and then every subsequent bubble peaks at 10 times above the previous bubble, and at bottom of every bear market is roughly 10 times above the bottom of the previous bear market, and it just has a sequence of kind of like a crazy adoption trajectory. But yes, that's if you measure your returns in dollars, then Bitcoin looks not something like you want to have on your balance sheet now. However, if you're a corporation or an insurance policy and you have to abide by all these rules, the only position in Bitcoin that's wrong is zero allocation, right? You can put 1% of your assets and sleep well at night, right? It's like an old joke about JP Morgan. One guy told him, look, I bought a stock, now it went up 10 times. I can't sleep at night. So JP Morgan told him, sell down your stock to your sleeping point. If your sleeping point is 10% of your assets in Bitcoin, you're done. If your sleeping point is 1% of your assets in Bitcoin, just have 1% of your net worth in Bitcoin. So if, for psychological reasons, just invest less into it, and maybe then you'll sleep better at night. All right, so let's talk about miners. Right. So let me just address the whole issue of FUD, fear, uncertainty, doubt, right? Hundreds of objections to Bitcoin have been raised over the years, and they keep getting recycled by the media on a regular basis. All of them have been put away to bed in some very long and very thoughtful Reddit threads from 2011. If you go to 2011 Reddit to our Bitcoin, every conceivable FUD objection to Bitcoin has been put to bed by multiple experts. So at this point, it's just media recycling more and more scare tactics in order to get you to click on that article to read about how Bitcoin will boil the oceans, or Bitcoin will be bad for poor people because it's highly unevenly distributed, or Bitcoin is bad for Africa because whatever. So let's talk about centralization and mining, right? So Bitcoin has miners. Now these miners actually have absolutely almost no power in the system whatsoever. In fact, a good metaphor for what mining is, it's like a clock on a wall of a bank branch where you walk into a branch, you're going to write out a check, and then at the last moment you look at the clock on the wall and it says 11:22. So you put 11:22 as the timestamp on your check, let's say. That's all that mining is. It's just a time-stamping mechanism to sequence the transactions. Now, miners have no ability to change the rules of the protocol. They have no ability to inflate anything. This has been proven by multiple incidents in Bitcoin history where, for example, some miners just attempted to issue more coins to themselves. Well, those blocks do not comply with the rules of Bitcoin, so they were just discarded by 100,000 nodes that will not accept illegal blocks, right? And unless a block is accepted by the entire network, it is just tossed out, and the miner spent $100,000 in electricity cost mining it, and there's nothing to show for it, right? So miners basically just have a privilege to submit, to burn $100,000 worth of electricity or whatever it is, to create a block and then submit it for consideration to Bitcoin nodes. And if this block doesn't comply with any of the hundreds of rules, it's just thrown away, right? So you can think of it as like Bitcoin is protected by this huge wall of validating nodes. It's the validating nodes that enforce all the rules of Bitcoin protocol, right? The miners just have a privilege of submitting candidates for consideration to extend the blockchain. Now, miners have the ability to decide which transactions they're going to stuff in the upcoming block. And they pick the transactions that pay them the most per byte of the available block space that they can create, right? So if the available block space is 4 million virtual bytes to create one block, the miners will pick those transactions first. They pay the highest revenue per virtual byte, right? So those transactions will be prioritized ahead of transactions that can wait for a few hours to be confirmed later at night when the traffic is slower. So miners basically get to be one side of the market of which transactions get frozen forever first. They get to decide which transactions get frozen forever first. Now, also the Bitcoin is designed in a way where miners can mine anonymously. They can themselves be untraceable. Not just Bitcoin nodes can be untraceable, but miners can be untraceable. And this is important because let's say there is only like 50 giant mining farms, and G20 governments around the world got together into a smoke-filled room, and now they have a conspiracy to shut down Bitcoin. Well, in theory, can they go to these 50 industrial mining facilities around the world and just shut them down? Well, they could if they could find them, right? But some miners already today, but other miners in the future can simply broadcast their blocks over Tor network, and then they become unfindable, right? So Bitcoin doesn't care if the blocks come from space, they come over Tor network, or they come over the internet, or they come from aliens. Bitcoin, as kind of this digital entity bank, is just eager to see the next block to extend its chain, right? Whatever the source of the block is. So All concerns about mining being concentrated in China and all that stuff, these are all red herrings. They're all basically completely invalid because Bitcoin decentralization is not based in decentralization of mining. It's based on the fact that you are self-sovereign in Bitcoin. If you have your laptop or a tiny computer, you can download the source code, audit the source code yourself, agree to all the rules of the system, and run it in a way where you will not depend on anybody else to audit the entire history or to accept any blocks or transactions. It'll be completely up to you. There's no trust required in any third party or in any peers or in any friends. It is completely self-sovereign, right? Meaning, what does sovereignty mean? Sovereignty means that you're not subject to anybody else's rules. That's what sovereignty means, right? An entity is sovereign if it's not subject to another entity's rules. Well, you can choose the rules of Bitcoin, or you can choose the rules of Litecoin, or maybe Monero. But let's say that you chose the rules of Bitcoin to adopt as your preferred monetary network. From that point on, nobody can show up and change the rules on you. Nobody can issue new rules or alter existing. I mean, existing rules cannot be altered or deleted in any way by anyone. And we can talk about why that is the case, why Bitcoin has attained this blessed status of fully decentralization. It's because it has become a rigid protocol on the internet. Now think about internet, right? It has billions of connected devices. Each one of those devices expects internet packets to be in a particular highly fragile format where every bit has to be where it has to be. Now let's say that all the governments of the world say, well, wait a second, we want to add a special new field into every IP packet that carries a signature of the person who sent the packet so that we can trace all the criminals, trading child porn or whatever on the internet. The internet simply will not care about these proclamations, right? Not even the government of China can change the standard for the internet computers to communicate with each other, even inside China, let alone around the world, even though they have total control of the population, right? The inertia of the protocol is so strong that it would be easier to change traffic rules in the United States to be left-hand sided traffic like it is in England or Australia. That would be easier to do than to alter rules of the internet or Bitcoin. There's more inertia in those rules because they've become widely accepted with no central authority whatsoever, right? Now, new rules can be added to the system. They're called soft forks. And the only thing they do is they just create additional constraints on allowed messages. So if you signed up to a Bitcoin version, whatever it was, 1.35 years ago, all the rules that you signed up for will continue to be enforced by the network indefinitely. However, additional constraints may be imposed by future versions that you didn't sign up for, but they're basically invisible to you because occasionally things that used to be valid from your perspective are no longer valid from the network's perspective. However, the converse, which is to say, whatever used to be invalid from your old perspective will never become valid from the network's perspective. In other words, it's a perfect backwards compatibility all the way to the initial 0.1 version released by Satoshi, right? And in fact, Bitcoin is that chain of blocks that is accepted by all past versions of Bitcoin and will continue to be accepted by all future versions of Bitcoin. The moment you have a version of Bitcoin that doesn't accept that one historical chain, that's called a fork. And a good example of that is Bitcoin Cash or Bitcoin Satoshi Vision or whatever. They've become irrelevant now because basically they went to zero relative to Bitcoin. They're under 1% of its capitalization now. But these were the cases where people said, we think that we can improve Bitcoin by altering one of the existing rules. So let's make blocks not 1 megabyte, but 100 megabyte. The moment they altered that rule, they could have altered the rule about 21 million max issuance, right? Because it's just another rule in a set of 1,000. The issuance schedule is just another rule in a set of 1,000 rules. The moment you can alter any of the existing rules, all credibility for the maximum issuance, for the scarcity, goes away. That's why none of the existing rules will ever be altered or deleted. Any system that can alter rules of Bitcoin and declare itself to be the true Bitcoin is basically not splitting Bitcoin, not even forking it. It's basically leaving the internet for its own private closed network. That's all it's doing, right? All right. So that's miners and decentralization. If you guys have questions while I'm looking at my notes, go ahead. Well, miners are not charging you transaction fees. You're just inserting transactions with arbitrary bids of your choosing. And miners only get to choose transactions that pay them more at any given moment. There's no set prices for transactions. When you send a transaction, you decide what fee to attach to it. Then miners see a pool of transactions competing to be included next. And they selectively pick those transactions that pay the most per byte, right? So it's kind of an ultimate free market in transaction fees, right? Miners just get to pick those transactions that happen to pay the most at the moment when they find a block. Oh yeah, that's been the case for years. So for example, right now, if you send a transaction with the smallest possible fee, it probably will not be included for a week. No, I don't. And here's why. Like I said in the beginning, Bitcoin base layer is designed for self-sovereignty and ultimate security in the face of all possible attacks by all the governments, right? The reason why Bitcoin has been impossible to stamp out is because its base layer is like it's more resilient than coronavirus, right? It's like it's designed to be impossible to stamp out and annihilate, right? It requires no identity. It can be operated anonymously by miners, by users. The reason why blocks only come every 10 minutes is precisely because that allows you to have a tiniest little straw of an internet connection that can be encrypted over Tor so that you cannot be found by the government and punished for operating your own Bitcoin node, right? That gives you the ability to sit on a tiny, very small internet connection, right? Because it's all designed for survivability. So what is that system good for? It's not going to be good for coffee transactions that pay $3. Think of every Bitcoin transaction as a super tanker that moves $1 billion. If a transaction moves $1 billion, even if the fees get to $100, they're completely negligible relative to all existing final settlement mechanisms in the world today, right? Think about how much it costs to move gold. Think about how much it costs to move $1 billion from Central Bank of the United States to some bank in Japan. That takes days and it takes a lot more. And even then, it's not truly final, right? Because there's been incidents where like this people hacked into a Fed account of the Bangladesh central bank, and they withdrew $600 million to multiple banks in Philippines, and it was like a worldwide chase, blah blah blah. But basically, think of Bitcoin transactions as super tankers carrying bars of gold each. So I want Bitcoin transactions to be $1,000 per transaction. That will be the new normal in the future. In the future, Bitcoin transactions will carry $1,000 fees. And the average amount of money moved by a Bitcoin transaction today, I think, is about $15,000. And the cost today could be anywhere from $3 to $15, depending on time of day or how crazy the market is. But being able to move $1 billion for $3 and have it be final and irreversible in 1 hour worldwide without any ability to censor the transfer, that's unheard of, right? So it's totally worth a few bucks. Just don't use it to buy coffee. Use it to move large amounts of money when you are escaping from a country whose government has gone crazy. Use it to move large payments between central banks, between commercial banks, whatever. Lightning Network, on top of Bitcoin, has infinite scalability, millions of transactions per second, each one of which costs less than a penny. If you want retail payments, use the Lightning Network on top. Yeah. Can you guys speak up? I can hardly hear you. Yeah. So that's an interesting thing here. Think of a Mexican standoff, right? There is, let's say, 200 banditos standing in the desert with their guns drawn, right? The situation with central banks and Bitcoin is very simple, is very similar to this kind of Mexican standoff. The first central bank that begins printing its own currency to acquire Bitcoin from its own population will get in early at 99% discount to all the others, right? So the situation is highly unstable. Now, we already know that North Korea is using slave labor and coal mining facilities to mine Bitcoin. And slave labor, it's exporting to Russia and China, and then it's converting the earnings into Bitcoin. It's selling heroin, converting earnings into Bitcoin. It's doing anything it can to convert earnings into Bitcoin, including hacking South Korean exchanges all the time, right? Iran is forced to do this. Venezuela has been confiscating all the miners in the country and mining Bitcoin for its own central banks. So that's already the case, except what's going to be different is that today only pariah states are doing it, right? There's nothing stopping a central bank of a small country like Singapore from quietly acquiring a few $1 billion worth of Bitcoin now, but announcing it 10 years later, right? The situation is highly unstable. This is like a prisoner's dilemma, where the first one to fire his weapon will walk out alive, and all the others will suffer greatly, right? But because of this instability in the game theory around central banks around Bitcoin, the fact that sooner or later some central bank will break ranks, acquire Bitcoin, and publicly announce it to the world, and that'll be a shot heard around the world, is essentially inevitable. I don't expect this to be in this bull cycle. In other words, in this bull market, Bitcoin might hit 200,000 to 300,000 by the end of the year, this year. But then there will be a usual bear market, maybe 50 to 80% correction, right? But in the subsequent bull market, where it breaks $1 million, I think that's when the central banks will get in. As far as central bankers are concerned, they basically have to have a complete brain transplant in order to accept Bitcoin, because Bitcoin contradicts every dogma of Keynesian economics you can think of, right? All the central banks in the fiat standard essentially operate in the context of Keynesianism, right? Which is basically a school of economics that's been in power since early 30s around the Western world, right? And Bitcoin is an existence proof that money does not need to come from government, right? And the whole of Keynesian economics is based on the idea that money can only come from government, right? So that's basically like straight up in their face. It's like denying the reality of a sunrise, right? There is a monetary commodity that's monetizing, that's being used to store value, that's being used for large settlement around the world, and yet it never came from any government. It just became invented, and then now it's being elected by the free market. In fact, it's the only free market, truly free market, that operates 24/7 in the world, in any good. It's truly the only free market. It's completely impossible to regulate, impossible to encumber. You can try to stamp out Bitcoin in any given country. China tried it, Russia tried it. What happened in China is that they had a very vibrant exchange industry, and then at one point in 2017, they told all the exchanges to shut down. So now Bitcoin trading in China is happening peer-to-peer, right? There's no need to discover the price of Bitcoin in China. Therefore, there's no need for this price discovery function of the markets anymore, because the price of Bitcoin is published around the world in US dollars, right? But there's a need for buyers and sellers to come together to exchange it, right? So people just use Telegram groups, or Weibo or whatever. So before, the government of China could see the exchange activity and could tax it. Now it can neither see it nor tax it, right? That's the only thing that changed. The amount of actual Bitcoin being bought and sold in China probably has gone up, but it's all peer-to-peer now. Well, this is a very interesting question. I do not believe that Bitcoin will obsolete the dollar. Let me just say straight out. I also do not believe that Bitcoin will obsolete governments. Now, that's kind of like there is an extremist libertarian position that says, why will we need the US dollar 20 years from now when everybody has Bitcoin on their phone? Well, the simple reason why you'll need US dollar is because you will go to jail or be killed if you don't use US dollar. That's the simple reason, right? The governments will continue issuing their own paper, which they will continue demand for payment and taxes, and they will continue to demand that all corporations maintain all their books and accounting in the local paper. So the US dollar and every other currency in the world will continue. What will change, though, is that rather than all foreign exchange, all currencies around the world being backed by a basket of other paper currencies, ultimately we're going into an era of a new gold standard. So the Bitcoin standard is a time 10, 15 years down the road where central banks have been accumulating Bitcoin, and now they use those reserves to back their own currencies as opposed to using gold or US dollars. But they still retain their local currency. United States will retain the US dollar. It'll just stop being a universal reserve currency used by other central banks, right? but it will continue to operate as a national currency unit of the United States. If you want to understand what the situation will look like during the Bitcoin standard, you can look at Argentina in the 80s or 90s, right? Argentina had this currency board system where every peso in circulation was backed by $1 at the reserve in reserve of the central bank of Argentina. So for 20 years they had no inflation, they had very rapid economic growth, and then they woke up one morning on Monday, and the government told them it's not 1-to-1 anymore; it's 3-to-1. Right? So they basically had 2/3 of their peso savings confiscated by the central bank overnight by simply devaluing their currency in one large leap from 1-to-1 to a dollar to 3-to-1 to a dollar. They had 2/3 of their wealth confiscated by the government, right? So the same system will prevail when Bitcoin standard normalizes, right? There will be no official announcement that our currency is now backed by Bitcoin. There will be not even official conversion rate for US dollar to Bitcoin, to Satoshis, let's say, right? Although some countries might want to clarify the situation, and it's completely feasible to see Switzerland or Singapore or Russia officially announced that they now define their local currency in terms of Satoshis. Just the same way as during the classical gold standard, French franc, British pound, US dollar, Deutschmark, they were all defined in terms of particular number of grams of gold, right? Of fractional grams of gold. So all these local currencies were basically local measures of the same monetary commodity, gold. So therefore, when you travel across Europe in the year 1900, you did not need to exchange money because all money was just promissory notes. There were receipts to get gold coins from local banks. It didn't matter what country you're in. All the exchange rates were locked to each other because they were locked to gold. That will be the standard in the future, except the new base reserve asset will be Satoshis, not grams of gold. But the United States and other countries will retain their local currencies that they will enforce onto the population, and they will retain that most important option to devalue if they need to, right? The option to confiscate savings from the population will remain in as much as those savings are stored in local fiat. But if you go to Argentina today, people pay with Argentine pesos to buy things on the street. But when people talk about buying cars, houses, or saving money for their kids, everybody uses US dollars, right? Nobody uses local paper. So you basically have this kind of split personality dual currency system where one currency is used for payments because it's imposed by the government, and completely another currency used for preservation of value across time, right? And that will be Satoshi. So that will be the future. We will all live in like high-tech version of Argentina where you will keep your value in Bitcoin while you'll be forced to pay taxes in your local fiat. And at the time of tax payment, you'll have to convert some of your Bitcoin to local fiat to pay off your taxes. Basically, that will be the system of the future. Okay. All right. It was my pleasure, guys. Thanks for your questions. Have a good day. Bye-bye.